Well, yes, the title of the presentation is The Macroeconomics of Inequality and Instability. I see quite a few familiar faces here in the room, so to many of you, some bits and pieces of what I will be presenting will probably be familiar. And actually, yeah, as Sebastian said, this what I will be presenting is based on a project that was supported by the Institute for New Economic Thinking that I did together with 3 colleagues at the IMK, Macroeconomic Policy Institute in Düsseldorf, Jan Behringer, Thomas Theobald, and Christian Belabet, who I think will also be at this conference, but I don't think they are here now because they are already bored by what or they would be bored by what I will be presenting, because actually we started this project a couple of years ago, and in the meantime, you know, there has been all this debate about the potential macroeconomic effects of income inequality, and so we have taken many new things on board, and the project has led us down a number of paths that we really didn't anticipate when starting this project. So I think there are still quite a few unanswered questions, and so I would be happy to discuss these with you. Okay, so this is the plan of what I want to do in this session. So I thought I could kind of split the presentation in 2 parts. In the first part, I will talk more about the theoretical underpinnings of the project, and also present some stylized facts that we then that we look at in the project. And in the second part of the presentation, I will talk more about our empirical work. Actually, we did a panel regression analysis for 20 countries where we look at the potential links between income distribution on the one hand and current account imbalances, which we see, and I think many economists would agree on this point as an indicator of financial fragility, macroeconomic instability. So yeah, in the first part, I try to answer the rather general question: how can macroeconomic or how can changes in income distribution affect macroeconomic stability or lead to macroeconomic instability? And so, yeah, this is what we do in our INET project. So, as I said, we try to contribute to this growing literature, which is by now quite large, actually, on income inequality as a cause of the global financial crisis that started in 2007, 2008. And more particularly, we look at the links between income distribution and current account imbalances. And as I said, we did a macro panel analysis for 20 countries. And the second part of my presentation will focus on this part of the project. We also built a 3-country stock flow consistent model that we also brought to real-world data and calibrated for the United States, Germany, and China. I think Antoine Gaudin earlier today talked about SFC modeling, so I will not talk much about this part of the project, but just give you an idea of what we have been doing here. And more recently, we also built a 2-country DSGE model that we calibrate for the UK and Germany. So in a way, our project tries to be pluralistic in the methods that we apply to this broader topic of income distribution and macroeconomic instability. And also, in a way, we try to combine 2 strands of the literature. The first strand of the literature that we take on board, if you like, is the post-Keynesian literature on wage-led growth or profit-led growth. And this literature, as you all know, looks especially at the functional income distribution. So the distribution of income between wages and on the one hand and profits on the other hand, or what to me is more seems to be more relevant, the distribution of income between the household sector on the one hand, and and the corporate sector on the other hand. And the second strand of the literature that we look at is the relative income hypothesis, or what has been called trickle-down consumption. So this idea that income inequality between households, so not between the household sector and the corporate sector, or between wages and profits, but really the distribution of household income across households, that this distribution affects aggregate consumption and various other macroeconomic variables. So this literature really looks at the personal income distribution, and I think this has been the focus of the more, if you like, mainstream literature. So in a way, we try to combine these two strands in the literature. Okay, so this was my rather general overview of what we try to do, and now let's start by looking at some theoretical explanations of this link between functional distribution, wages, profits, or household income, corporate income, and aggregate demand. So in the standard rational expectations models, there is actually no link between the functional distribution and aggregate demand. And the reason for this is that this is what in this mainstream literature is called a full piercing of the corporate veil. Okay, so the distribution of income between households and the corporate sector doesn't really have an effect on aggregate demand in a mainstream model, because ultimately the corporate sector is owned by households, and if these households are fully rational, then their behavior will always fully offset the behavior of the corporate sector. Or in other words, the household sector will always be able to fully control the aggregate amount of saving in the economy, or more generally the financial decisions of the economy as a whole, because they know what is going on within the corporate sector, and with their behavior they will always offset trends within the corporate sector. So for example, if the corporate sector increases its saving because profits go up, so you have a shift in the functional distribution, wages go down, profits go up, and the corporate sector saves more. Then, in these rational expectations models, if households are fully rational, they will see that their wealth goes up because they are the owners of the corporate sector. Therefore, they will feel richer, and they will then reduce their saving, okay, so that the aggregate saving in the economy will remain unchanged. And this is really an equivalent to this notion of Ricardian equivalence, okay? Because the same is true here for the government sector. So households not only pierce the corporate veil, but they also pierce through what you could call the government veil. And I guess you all are all familiar with this concept of Ricardian equivalence. If the government sector runs a deficit, then rational households, who in a way are seen here as the owners of the government, they will anticipate that in the future the government will have to raise taxes in order to repay its debt. And therefore, the household sector will then start to save more now in order to be prepared to pay the anticipated higher taxes in the future, okay? And the same is true in these models for the corporate sector. If the corporate sector increases its deficit, but the owners of the corporations, they don't, want to reduce their saving, then the household sector will then increase its saving. And so, in that sense, not only government deficits are neutral in terms of aggregate demand, but also the distribution between income between the household and the government sector. And then the second point here, this literature, you could still call that kind of mainstream, because the argument has been made that, well, maybe households are not fully rational, and they don't really take into account the financing decisions of the corporate sector. And so if wages go down, profits go up, the corporate sector saves more, then households may actually not lower their saving and offset the increased saving of the corporate sector, and therefore you may get real saving effects. So the aggregate saving rate may go up, aggregate demand will go down, and therefore the economy may actually go into depression, because the purchasing power of the household sector goes down, and therefore you get a drag on aggregate demand. So there is some mainstream literature on this, what is called incomplete piercing of the corporate veil. And this is kind of familiar to post-Keynesians who have always, and other heterodox schools of thought, who have always argued that the distribution of income between sectors will affect aggregate demand. You find this in Hobson, 1909. You find this in Kalecki, obviously, also in Kaldor. And you also find this in more modern post-Keynesian models like the Baduri and Marklin model. And as you may all know, the Baduri and Marklin model introduces this distinction between wage-led growth on the one hand and profit-led growth on the other hand. Because they argue that, well, on the one hand, it's true that if wages go down at the expense of profits, then this may depress consumption demand in the economy. But on the other hand, it may be the case that higher profits lead to a higher propensity, lead to a higher investment demand on the part of firms, because if profitability goes up, this may induce firms to invest more. And because investment is also part of aggregate demand, it may actually be the case that the negative consumption effects of a lower wage share are more than offset by an increase in investment demand. And so in this Baduri and Marklin model, actually you have these two possibilities. A reduction in the wage share may have either expansionary effects if investment reacts strongly to higher profits, or it may have contractionary effects if consumption reacts very strongly to lower wages, but investment doesn't react that strongly to higher profit share. Okay, so this is a very, let's say, brute summary of the potential effects of changes in the functional income distribution within different theoretical frameworks. Okay, so yeah, I think I can skip this slide. It just summarizes the Baduri and Marklin model, where you have a saving function, you have an investment function, and then you have capacity utilization, and you have the wage share affects both saving and investment, and depending on which effect is stronger, you get either expansionary or contractionary effects on demand. I guess this is very well known to most of you. And then in an open economy context, obviously, and this is what we will look at later, if reduction in the wage share has contractionary effects, this should also show up in a current account surplus, because a weaker domestic demand will translate into a current account surplus. And if you are in a profit-led system, lower wage share leads to expansionary effects and higher domestic demand, then you will end up with a current account deficit. So this is the link that we see between income distribution and the current account. And this is why in the empirical application we focus on the current account as a kind of summary indicator of the effects of income distribution on demand on the overall economy. Okay, so now from a theoretical perspective, again, what are the potential effects of changes in personal income distribution on aggregate demand? And I think it's really important to distinguish these different kinds of distribution. I think they are very different, and in many models, I think they are kind of convoluted and mixed up. But I think it's really important to distinguish these two different distributions and their effects on demand carefully. Again, in rational expectations models, you have no effect, actually, of income inequality between households on aggregate demand. So actually, in most mainstream macroeconomic models, at least before the crisis, you had this infamous representative agent, and so by definition, income inequality effects are assumed away, because there is no income distribution if there's only one household. And the theoretical justifications for this in these models was always that, rational households, they will always consume on the basis of their permanent income or lifetime income. And it shouldn't matter if you are a high-income household or a low-income household, you always have the same propensity to to spend, ceteris paribus, because all that you look at is really your permanent income or your lifetime income. The traditional Keynesian argument, on the other hand, was that a rise in income inequality will weaken aggregate demand, right? I mean, this is how I was trained, and probably most of you were trained. That is to say, if inequality goes up, this will be a drag on demand. Why? Because income is redistributed away from people with a high propensity to consume. These are, lower and middle income groups, to rich households with high incomes that have a high propensity to save, a lower propensity to consume. And therefore, according to this traditional Keynesian argument, you find this in the General Theory, 1936, if inequality goes up, this tends to depress consumption demand, and this tends to depress aggregate demand. The third bullet point here talks about a different class of models that has been called the Expenditure Cascades model by Robert Frank and others. Others have called this the Trickle-Down consumption model. And in these models, actually the opposite occurs. If inequality goes up, the saving rate goes down. So in a way, this has expansionary effects on consumption. And why is this? Because we know from psychology that we tend to compare ourselves to others that have a slightly higher income than we have. Okay, so this is what is meant by upward-looking status comparisons. So if other people's incomes go up, they tend to consume more, and so we start to try and emulate the higher consumption of the rich. But if our income hasn't increased, we need to reduce our saving rate in order to maintain the relative our relative level of consumption compared to other people above us in the income distribution ladder. Okay, this is very briefly what the relative income hypothesis with upward-looking status comparison says. I will come back to this point in more detail later. And so this last bullet point here is linked to the third one, because in one way or the other, I think this relative income hypothesis with upward-looking status comparisons, which is based on consumption emulation, is used by different, or has been used by different authors in recent years to explain the link between the rise in income inequality, especially in the United States, but also in the UK, on the one hand, and the financial crisis. Because what this literature says, and this combines both post-Keynesian authors like Thomas Pally, Barry Cinnamon, and Steve Fazzari have done very interesting work on this, but also more mainstream thinkers like Fitoussi and Stiglitz, Raghuram Rajan, the former chief economist of the International Monetary Fund, Michael Kumhoff, who used to work for the International Monetary Fund as well and is now at the Bank of England, and this is another post-Keynesian author, Engelbert Stockhammer. They say very similar things. That is, the rise in income inequality starting in the early 80s in the US has induced households below the top of the income distribution to reduce their saving because they tried to keep up with the rising living standards of people at the top of the distribution. And so they reduced their saving, but they also increased their debt because they try to maintain their relative standard of living on the basis of rising household indebtedness. This had an expansionary effect on the economy for some time because it led to lower saving rate, higher consumption, also current account deficit. But in the longer term, it increased the financial fragility of the economy because household indebtedness increased substantially and then triggered the financial crisis in 2007. So if you believe in that kind of story, this is really not a Keynesian story. I think we can all agree, because from a Keynesian perspective, you would normally expect that if inequality goes up, then you will end up with weak consumption because the rich saved so much, okay? And so here is some maybe problem for Keynesians. Okay. This is just an empirical illustration of what I just said. I will not go through it. It just illustrates the different hypotheses in the permanent income hypothesis and in the Keynesian consumption theory and in the relative income hypothesis. So to summarize, in the permanent income hypothesis, there is no link between inequality and saving or consumption. In Keynes and in the relative income hypothesis, high-income groups will have a higher propensity to save than low-income groups. But if inequality goes up, then in the Keynesian model, typically you will have an increase in the aggregate saving rate. But in the relative income hypothesis with upward-looking status comparisons, you will see a decline in the aggregate saving rate, okay? So these are just three different ways of modeling the effects of inequality on aggregate saving and consumption. Okay. Yeah, the relative income hypothesis obviously goes back to people like James Duisburg, who was the first economist to model the relative income hypothesis. It also goes back to the sociological literature, Veblen and others at the end of the 19th century. A modern version of the relative income hypothesis has been formulated by Robert Frank, whose work I strongly recommend. And so, as I said before, if income inequality goes up permanently, according to the relative income hypothesis with upward-looking status comparisons, you would expect that saving goes down, but also that debt goes up, household debt, because households try to keep up their consumption standards relative to the rich by going into debt. But also you would expect that the labor supply goes up because households below the top of the distribution, they will also try to work more in an attempt to maintain their relative incomes. And here the important distinction that is made by Robert Frank and others is that between positional goods and non-positional goods, okay? Saving, according to this literature, is a non-positional good. You cannot show off with your savings, okay? You don't go out and tell your neighbors, I have so much money in my bank account. You don't see it, but it's true. So I have a high social status, okay? In that sense, saving is a non-positional good. Also, leisure is a non-positional good, okay? Few people will, show off with their neighbors saying, I have more leisure than you have, okay? At least in our, world with materialistic, values. But you can show off with a high level of consumption, okay? With your car and with your house. You can also show off with your children's education, okay? I think this is very important, especially in the US and in the UK, where education has to be bought with private money. And so if you buy expensive education for your kids, this is a signal of social status, okay? And therefore, according to this model, there is always a bias towards positional goods at the expense of non-positional goods. And if rich people see their income increase, they spend more on positional goods. This puts pressure on people below the top of the distribution to reduce their, if you like, consumption of non-positional goods, to save less, to work more and consume less leisure in order to keep up in terms of positional goods. And in the US and in the UK, where basically everything that matters to middle-class families has to be bought privately, this pressure may be much stronger than in other countries, okay? And so this is why we argue in our project that the strength of these expenditure cascades depends heavily on social norms and also social institutions. In Germany, for example, it doesn't really matter to which university you send your kids, right? It doesn't really matter to which school you send your kids because everything is financed publicly. And so this competition in terms of positional good, the room for positional arms races is more limited in Germany, where we have a rather well-functioning education system, health system, and so on, publicly financed, than in the US and partly in the UK, where these things have to be bought privately. So this is the first thing I think that we contribute in the project to show the importance of institutions and social norms for these expenditure cascades. Another thing that is important is it is really important to look at the exact change in income inequality. It makes a huge difference if income inequality increases at the top of the distribution, at the very top, let's say the top 1%, top 5%, or at the bottom of the distribution, okay? I mean, why is this? If you compare Germany and the US, what we do a lot in our project, and you look at the change in the Gini coefficient of household income from the mid-1980s to the mid-2000s, just before the crisis, you see a very similar increase in the Gini coefficient. So overall income inequality has increased to a similar extent in the US and the UK. But in the US, the increase in the Gini coefficient can be attributed largely to an increase of income inequality at the very top of the distribution. So this is this opposition between the top 1% and the bottom 99% in the US, okay? In Germany, the top 1% income share has remained rather stable over the past 30 years. And income inequality has increased because the bottom half of the income distribution has fallen behind. And what we argue in this project is that the macroeconomic effects, the consumption effects of these two very different patterns of the rise in income inequality will be very different. And why is this? Because if the top 1% increases its income and they spend $1 million more on their children's education, this puts pressure on those income groups just below the top 1%, okay? Those households just below the top 1% or below the top 5% in the US were those households with the strongest decline in their relative incomes. So they had the best reasons to emulate the consumption spending of the top 1% because they compared themselves to those just below, above them in the income distribution. This is the top 1% is the reference group for the next 1% in the income distribution, okay? Because this is the same social environment, and this is where social comparisons take place. And so there was a very strong pressure, according to this model, for the upper middle class in the United States to reduce their saving, to go increasingly into debt, to work more in order to keep up with the rising consumption patterns of the top 1%. But and in Germany, this was simply not the case, because the income distribution in the top quintile was roughly stable, and only in the bottom half of the distribution did the income inequality increase significantly. But it makes a huge difference if the upper middle class reduces their saving dramatically, or if the bottom half of the population reduces their saving dramatically. Because if the bottom 50% of the distribution reduce their saving rate, the aggregate effect is very small, because the bottom 50% of the distribution, they hardly have any income. And so the effect on the aggregate saving rate will be small. But if you see the aggregate saving rate decline substantially, this must be due in some sense to lower consumption by the middle class and the upper middle class, because these are the income groups that have a lot of income, and therefore they account for a large share of the aggregate saving rate. Okay, let me try and give you some illustration of this. Okay, I will skip this. This is what I just said. This is the change in the Gini coefficient in different OECD countries. As I said, I always compare United States and Germany. This is the United States. You see a significant increase in the Gini coefficient, and this is Germany. And the increase in the Gini was more or less the same. But, and this is what I will do now, look at the case of the US and then look at the case of Germany. If you take a closer look at what happened really to income distribution, you will see that the cases were very different. Okay, here's what happened in the US. These are the famous top household income shares that have been produced by Thomas Piketty and his co-authors. And you all know this graph. This starts in 1970 until today. And actually, between 1960 and 1980, you had rather stable top household income shares. This is the top 10. This is the top 1% income share, top 5%, top 10%. And they started to go up dramatically in the early 1980s. So in the 1970s, the top 1% had 8% of aggregate household income. Just before the crisis, the top 1% of the income distribution accounted for 20% of aggregate household income. Top 5% 20% of aggregate incomes this is pre-tax income, in 1970, 1/3 of total incomes today. Top 10%, roughly 1/3 of total pre-tax income in the 1970s, and almost 50% just before the crisis. So this increase in the Gini coefficient in the US can be attributed largely to this increase in inequality at the very top of the distribution, okay? And now look at what happened to the functional distribution in the United States. Because as I said, in the project we try to combine these two distributions. Actually, nothing much happened, I would argue. And this is the wage share. There is a slight decline in the wage share. And this is the share of household income in total national income, okay? There is a slight decline in the wage share, but the share of household income and national income, which I would argue is much more important than the wage share, remained roughly stable, okay? And now look at what happened to saving and debt. I mean, this is probably also familiar to you. This is the saving rate here, the blue line, which was roughly stable between 1960 and 1980, and then declined dramatically at the exact same moment when income inequality went up. And this is household leverage, household debt relative to household disposable income, which was roughly stable between 1960 and 1980, and then increased to approximately 130% just before the crisis, and this then triggered the financial crisis, okay? So very surprising from a Keynesian point of view, because as a Keynesian you would typically expect if inequality goes up, then consumption goes down and saving goes up, but the opposite actually happened. Aggregate demand was driven by private consumption and also residential investment in the US over the 30 years period before the crisis, and this despite the relative decline in the bottom 99% incomes, and this was supported by this increase in debt, which then triggered the crisis. Okay, and in our view, the functional distribution really played only a marginal role in explaining these macroeconomic effects, because really nothing much happened to the functional distribution. Okay, and there's also some microeconomic evidence for what I just said. If you look at saving rates by wealth classes, so this is a figure produced by Emmanuel Saez and Zückmann in a paper published last year, and you can see that the saving rate of the top 1% actually remained rather stable in the period of interest between 1970 and the crisis, and the saving rate of the income group just below the top 1% declined dramatically, okay? And this is what really drove the decline in the aggregate saving rate, because this is where all the income is, okay? The saving rate of the bottom 90% also decreased, but this alone cannot explain this decline in the aggregate saving rate, simply because the income share of the bottom 90% is not large enough to explain this decrease in the aggregate household saving rate. And so the behavioral explanation in the relative income model would be the top 1% is really the social reference group for the income groups just below, and they were really put under pressure to reduce their saving, to go more heavily into debt in order to to keep their kids basically in the best schools and universities that money can buy, and also to live in relatively decent neighborhoods, houses, compared to the houses that the top 1% could easily afford because their incomes went through the roof. So that would be our basic story for the US, which is now shared by many both mainstream and heterodox economists. And I think it's a puzzle for Keynesians, kind of. Okay, here you see also evidence for what I just said, produced by Michael Kummer from the International Monetary Fund, with based on data from the Survey of Consumer Finances. And here you can see that this is the debt to net worth ratio, the leverage ratio, of the bottom 95% of the population, okay, in the US. So the debt to net worth ratio of the bottom 95% of the population remained rather constant. No, sorry. This is the top 5%, okay? The leverage ratio of the top 5% remained constant. And this is the leverage ratio of the bottom 95% of the population. So it was really at the bottom 95% of the population that leverage went up. These households went increasingly into debt, and if you believe in the relative income hypothesis, then this was based on basically emulation and keeping up with the rich kind of behavior. Okay, so we would conclude that mainstream theories of consumption are really unable to explain the decline in household saving rate and rise in household debt in the United States. And since the 1980s, the mainstream economists, they were always, wondering why the hell is the saving rate declining in the US? And they came up with all sorts of explanations. And in the end, mostly they said, well, there has to be some exogenous shock in preferences or something like that. Or some were even arguing, well, the likelihood of a nuclear war has gone up, and therefore people didn't even bother to save, because, I mean, why save if we all expect a nuclear war? So I mean, the mainstream theories really failed in explaining the very important stylized facts that I just tried to put to you. In our view, the most persuasive explanation of these stylized facts is really the expenditure cascades or trickle-down consumption model. Okay. And we would also argue that, in post-Keynesian circles or heterodox circles, for a long time, a lot of attention has been put to the functional distribution between wages and profits. And many models have been, formulated and estimated and trying to figure out if the economy was wage-led or profit-led. All know that kind of literature. And in our view, they really kind of miss a very important part of the picture by looking exclusively on the functional distribution between wages and profits. And actually, this is an aside, but if you look at the Baduri-Marklin model in detail, they are not really interested in the wage share and the profit share. What they are interested in is the shares of income going to households on the one hand and corporations on the other hand, okay? Because there's, this distinction makes sense. Households have a different propensity probably to save and to consume than corporations. But why should households have a different propensity to consume from wage income and capital income? To me, this distinction doesn't really make sense. And in the beginning, I always also followed this route and tried to model the Baduri-Marklin model in different ways and to estimate it in different ways. But increasingly, I'm convinced that firstly, the distinction between wages and profits is not really the most interesting distinction in terms of income distribution. And also in the United States, the functional distribution has remained roughly stable over the 30 years before the crisis, so you really have to take into account a personal income distribution. And many models now take this into account, but I think for a long time, post-Keynesian heterodox authors, they focus to, at least in my view, somewhat excessively on the functional income distribution. Okay, so I'm slow, but don't worry, I will be much quicker here. Now let's look at some stylized facts for Germany. As I said, in our panel analysis, we look at 20 countries and we try to generalize the stories that we are telling for the US and for the UK, for Germany. But let's have a look at Germany, which is kind of the polar opposite of what we see in the US. So here we have, again, personal distribution and functional distribution. This is personal distribution. Remember that the Gini coefficient increased roughly to the same extent in Germany as in the UK, as a broad measure of income inequality. And the OECD and the IMF recently, they have built models and estimated panel econometric models where they argue that changes in the Gini coefficient can be related to economic growth. So a higher Gini has led to lower growth. In my view, this focus simply on the Gini coefficient is problematic when you look at macroeconomic stability and when you look at the links between income distribution and macroeconomic trends. Okay, because if you just look at the Gini, you would argue, okay, the shifts in distribution have been very similar in the US and the UK. But when you look at our preferred measures, top household income shares on the one hand and the functional distribution on the other hand, the picture is very different. So these are top household income shares in Germany, okay? So 1970 to 2007, the top 1% income share is stable. So very different from the US. This is the top 5% income share. Also, you don't see much of an increase. And this is the top 10% income share, which goes up a bit more. But, I mean, no comparison to the US. And we would argue that this is why less pressure was put on the upper middle class to reduce their saving, go increasingly into debt, because simply they weren't put under pressure by the top 1%, the top 5%, spending more on positional goods. Okay, this is our kind of simple argument. On the right-hand side, you see the functional distribution in Germany. And here I would argue that the post-Keynesian literature on wage-led growth, profit-led growth is much more relevant because you see a very dramatic shift in the functional distribution of income starting in the late 1990s. So the blue line here is the share of capital income and national income, very strong increase in profit at the expense of wages. And the red line are retained corporate earnings as a share of private income. Okay, so what happened in Germany was that wages went down at the expense of profits. Profits increased very strongly, and corporations, unlike in the US, didn't pass on these rising profits to top income households like managers, top CEOs, and shareholders. But they retained these profits within the corporations, okay? And we would argue that this had important macroeconomic effects in Germany because the rising profits didn't end up in the household sector. They were not spent by the top income households, but they remained stuck within the corporation and thereby depressed aggregate demand in Germany, which then showed up also in the current account surpluses, this rising dependence of the German economy on net exports, okay? And also, I think it's important to understand that these two trends here are linked because, I mean, just think of this following thought experiment. If the rising profits of German corporations had not been retained within the corporations, but rather distributed in terms of management pay or dividend payouts to top income households, because these are essentially the owners of the corporate sector, then the top household income shares would have increased much more strongly, okay? So this is how we believe these two trends are really linked. So this is something that we did in a policy-oriented paper. We took the top household income shares for Germany, 1998, no, this is 1995, 1998, 2007. This is the top 1%, this is the top 5% plus top 1%, and this is top 10% plus 5 and 1, okay? So if you just take these top household income shares, you don't see much of an increase. But if you add to this simply the profits retained by the corporations, then these adjusted top household income shares increase much more strongly, okay? So in a way, when you don't talk about macroeconomics, but just try and compare changes in income distribution across countries, I think it's a mistake just to look at the top household income shares and say, in the US, top household income shares increase a lot, so there is an increase in inequality and so on, whereas in Germany, income inequality remains stable because, as we see here, the top household income shares remain stable. I mean, that's true, but ultimately, the retained corporate earnings of the corporations can in some way be counted as income belonging to the top household incomes, because these households are those households that own the corporations. And if you add the retained corporate earnings to the top household income shares, you get a very different picture, okay? And what we also argue is that from a macroeconomic perspective, this distinction between top household income and retained corporate earnings is not neutral, because these are the three sectoral financial balances for Germany, okay? The blue bars are the private household financial balances, income minus expenditures of the private households, from 1991 to today. And in Germany, private households always have financial surpluses, because the Germans, I mean, they are the Germans, so they always have these private surpluses, very unlike the United States, right? This is the public sector, the green bars. They used to have deficits, but now we have this funny, this funny article written into our constitution that doesn't allow the government sector to run deficits, and so the government sector doesn't run a deficit anymore. But now look at the interesting thing, the red bars. This is the financial balance of the corporate sector. It used to be in deficit between 1991 and 2000, and this is what corporations normally should do. They should run deficits. But since 2002, in every single year, the corporate sector has run financial surpluses, okay? And this is, of course, linked to the explosion of profits starting in the late 1990s, which were retained by corporations. So not only does this rather peculiar corporate behavior affect the top household income shares, it also has macroeconomic effects, because these financial surpluses of the corporate sector in an important way contributed to the current account surpluses of Germany and the depression of domestic demand in Germany. Okay. Yes, so well, I'm really slow today, but I mean, my main goal was to, get across this basic intuition and argue that you really need to look at personal inequality and functional income distribution. And so in our project, I mean, if you're interested, you can read our papers. We modeled this in an SFC model. I will just show you the balance sheet of the SFC model. It's a three-country model for the United States, Germany, and China. And in each country, we have 10 households, okay? We have firms and banks. So basically what is important is we have income distribution between the household sector and the firm sector, and we have income distribution across households. And so, and this for the three countries, and we then calibrate the model to US, German, and Chinese data. And then basically with this model, we try to tell the story that I have tried to explain up to now. And so what is really important in the model is that because income inequality in the US increased primarily because top household incomes went up, we find in the model, so you can see this here, that especially the leverage ratio of the second and the third highest deciles increased very strongly, because it was the second and the third highest deciles that tried to emulate the rising consumption spending of the top decile. And this is very important from a macroeconomic perspective, because the second and third highest deciles account for a large share of income, and therefore they have a large effect on the aggregate saving rate. And then we also find that the consumption to GDP ratio goes up, and we also see a current account deficit in this closed system of three economies. And in the other countries, this is Germany and China, you don't see this increase in debt, okay? You see some increase in that in the bottom half of the distribution because, I mean, we incorporated the relative income hypothesis into this model, and because the rise in inequality in Germany occurred in the bottom half of the population, these households, they really tried, and the bottom income households, they tried and emulate the rising consumption of the middle class, but the effect on the aggregate leverage ratio and also the effect on the aggregate saving ratio was relatively minor. But what we have in Germany, and also I won't talk about China here, but what we have in Germany is this very strong decrease in the wage share, decrease in the share of household income in aggregate income, and this depresses consumption, and we end up with a current account surplus. Okay, so this is our main finding here from this calibrated SFC model. Okay, I will very briefly talk about our panel analysis. I mean, many economists have thought about the current account imbalances, but there is a big problem with this literature, and that is that it has so far proven very difficult to explain the emergence and persistence of the global imbalances in a fully satisfactory manner. So these panel regression analysis, they are unable to explain the current account imbalances. And so what we are doing basically in this paper is to incorporate measures of personal income inequality and functional income distribution into these otherwise very standard panel estimation models of the current account. Okay, and so we look at 20 countries, and in a way we can confirm the, let's say, intuitive story that we are telling for the US and Germany. So, well, let me skip this. Yeah, this may be interesting at the first, illustrative or as a first illustration of our hypothesis. This now is for 20 countries, mainly industrialized countries for which we have data. This, on the horizontal axis, is the change in the corporate financial balance, okay, the change in corporate net saving from the mid-1980s to the mid-2000s, so the 30 years period before the crisis. And this is the change in the current account balance for these same countries. And what you can see here is a very clear positive correlation between the change in the corporate financial balance, corporate net savings, and the current account balance. Okay? And this, I mean, to most of you, probably this doesn't look very surprising because, I mean, as we could see here for Germany, I mean, by simple accounting, the corporate financial balance is part of the current account balance. So if the corporate financial balance goes up, so we may well expect that the current account kind of follows. But for, I mean, mainstream people, this positive correlation is kind of surprising because if you believe that households are rational and fully pierce the corporate veil, you would expect that changes in the corporate financial balance have no effect whatsoever on the macroeconomy, because you would always expect that, similar to Ricardian equivalence, if the corporate sector increases its net saving, the household sector will offset this rise in saving by lowering its saving and by lowering its financial balance. But as you can see here, there is no consistent negative link between the change in the corporate financial balance and the change in the household financial balance. Okay, so this is, I mean, some first illustration of the potential importance of the corporate sector net saving and therefore the functional income distribution for the current account balances. Okay, and what we can see here is also some illustrative confirmation of our hypothesis that in those countries where the top 5% income share has increased most or has increased strongly, the current account will have decreased. So you get a negative correlation between the change in the top 5% income share on the one hand and the current account. So this is kind of a generalization of the macroeconomic patterns that we saw for the United States. Okay, in those countries where top household incomes increased very strongly, pressure was put on the upper middle class to emulate the consumption of the top 5%, and this led to lower saving and ultimately to a decrease in the current account. Okay, so, and then we did these standard estimations. What we did basically was to regress the current account on a standard set of explanatory variables, and then we added measures of the functional income distribution and of personal income inequality. And we did this similar sets of regressions for the financial balance of the household sector and the financial balance of the corporate sector. I won't go into the details of these two latter equations, but I will briefly, talk about our estimation results for the panel regression analysis. So, I mean, I won't bore you, and I mean, because I run out of time, but also because it's boring. I will not bore you with the estimation approach. So this is all very standard. We basically try to replicate previous IMF and OECD estimations, but then we included our income distribution variables. And so here are our estimation results. So you really have to look into the paper if you're interested, but consistently we get a very strong and positive effect of the corporate financial balance on the current account, okay? We also did this as a robustness check. We did this for the weight share and the profit share. So you get a positive effect of the profit share on the current account. And also another robust finding is that we get a very strong and significant negative effect of the top 1% income share or other income inequality measures on the current account. Okay, so you have very different effects of the functional distribution and the personal distribution. Okay, and then also quantitatively, I'm not sure you can see this, but in a contribution analysis, we looked at which variable could explain what fraction of the change in the current account balance from the mid-1980s to just before the crisis. And we find that the change in the top 1% income share, for example, accounted for approximately 2 percentage points of the decrease in the current account balance for the US between the mid-80s and just before the crisis. And for Germany, we get a rather large effect of the corporate balance. So, the persistence of the current account balance of Germany, which is a sign of very weak domestic demand for the past 15 years, is partly due to this rise in profits and by the rising retained profits of corporations. So this is basically what this figure tells you. Okay, so this is my last slide. Our main results are, as I just said, an increase in personal inequality leads to a decrease of the current account ceteris paribus. An increase in the corporate financial balance leads to an increase in the current account. And also a fall in the weight share leads to an increase in the current account balance. And according to our estimations, at least the joint effects, because you really have to look at the two distributional variables, they contribute to the explanation of the current account imbalances observed prior to the Great Recession in our panel of 20 countries. Okay, thanks a lot.